Okay, so here is the walkthrough of these problems here um, from what we were going to go over in class. I guess that was last night. I'll just quickly go through these, hopefully explain a little bit as I go. I'll kind of pause intermittently so you don't have to watch me typing in stuff. But I'll try to explain everything fairly thoroughly. So for most of these that have the basic accounting equation as what is supposed to be being tested in the question, it's basically a simple algebra problem where you see question marks. Essentially, that's your x. So you're going to solve for x for each of these. So just as an example of how that works, I know assets, I know equity, I don't know liabilities, so that's my x. And so I would say 281,000 equals x plus 210,750. And to get that x by itself, I would subtract 210,750 from both sides of the equation. And that would give me what needs to go in x. So essentially that would leave me with the equation 281,000 minus 210,750 equals x. So for this Excel cell that I highlight here, I'll just put the equation in here equals 281,000 minus 210,750. And so that's my equation. So obviously to test that, I would just make sure that this plus this equals this, and we know that it does. Obviously Excel doesn't make math errors as long as you enter the equation correctly. So I'll fill the rest of these in that same way on this question here. First, 281,000 plus 80,000 equals, just highlight that, plus, highlight that. Gives me my total there. Same thing for liabilities. This amount plus this amount, this amount gives me this gave me my assets, this gives me my liabilities. And again, I just need to solve for x here. I don't need to worry about what's up here, because given these two, I can solve for x like I did over here, and that's just going to be this number minus this number. So 361,000 minus, and I can tell by just doing the math there, or I can have Excel do it if I want, equals the difference between this number and this number. Or I could have gone this way. Okay, same deal. Similar to playing, I guess, not really play much, but similar to playing Sudoku or doing similar type puzzles to that. I know that doesn't exactly test your knowledge of accounting, but it is what it is. Same deal here, equals assets minus liabilities. So that's just kind of another way of saying, hey, if I wanted to manipulate this equation, I could set it up where equity equals assets minus liabilities, just by subtracting liabilities from both sides. And that is the same as saying, well, if I want to solve for equity, that's my unknown. I just need to isolate that on one side of the equal sign, and whatever's left on the other side is my equation. Sorry for those of you that are not math folks, maybe all of you, I'm sorry to all of you then. But I swear it's not terribly complicated math. You shouldn't have, in this class, you won't have to do more than add, subtract, divide. I guess this is algebraic manipulation is probably the most complicated math you'll have to do. Okay, so we'll just quickly do some of the rest of these. I'm just working backwards here. Equals 190 minus 60 And then here equals this number plus this number. And I guess I should have mentioned this before, but yeah, I just plugged the givens from the word problems into these little tables for a better idea as to what we're actually looking at in terms of the basic accounting equation and how to solve that. So yeah, that's how I got to this format from these words. But I'm pretty sure I gave you all yeah, this is what I gave you. So yeah, you already had the formatting in there. At any rate, so working left to right here, again, assets minus liabilities in this case. And that's all for that one. Okay, for these financial statements, they're pretty basic. There's not a lot of any calculating, much of any calculating going on. We're just simply pulling out the relevant accounts and putting them on the income statement or on the financial statement that is where they live, where they're supposed to go. So for the income statement, that would be any accounts that are revenue or expense. So that would be starting here in this listing. Consulting fees earned would be my only revenue account. I'll list that here. Excuse me. 14,740. That's my only revenue. Expenses would be the rest of these here. Yeah, so expense accounts, just in this case, all the ones labeled expense. And that's typically the case for most of them. They will have the word in it, so it's not a huge mystery as to which ones we're talking about. Rent expense, salaries expense, telephone expense, and miscellaneous expense. And then I would total all of those up. Auto sum is going to give me everything in that highlighted box. Total those there. And then obviously my net income would be the difference between my expenses and my revenue for this period. So I'll just put that into the calculation here. Equals this cell minus this cell. And that is my net income for the period. And if that was a negative number, I guess I should have put in parentheses here or net loss. Because if this is a negative number, obviously that would be a net loss. Okay, over here in the next one down, statement of changes in owner's equity. We're going to come up here and see if we're given any beginning balance. Yeah, on October 1st, there was nothing in there, which was the beginning date of the company. Then on October 3rd, there was this contribution. And then what else is relevant to the owner's capital account? We've got that contribution listed here. Got some cash withdrawals. And it looks like the only other thing would be our net income. So we'll pull those two items out. Start down here. Beginning capital in this case would have been 0. To that we would, well, let me put that over here. To that we would add owner contributions for the period, and that was this amount right here, owner investments, $84,780. And then we're going to add, again, like I said, net income, which we calculated here. So I'll just say use that number. And from that, we will only have to subtract owners' withdrawals. And that was this amount right here. Cash withdrawals by the owner, $2,830. I can either list that, it's kind of a preference thing, but I can list that as a positive number and just make sure that I'm subtracting it, or I can list it as a negative number and just add all the way down. Probably in Excel, the easiest thing to do would be listed as a negative number. That way I can just come over here. Whoops, that I did not want to do. Is that the right amount? Yeah, okay. So list that as a negative number, and then I come down here and I can just auto sum, and I'll include all of those, and it's just going to add all of those together. And that gets me to my ending balance for owner's capital. So that's going to come over here, obviously, into my owner's equity slot here. And again, when I say owner's capital or owner's equity, what you should be thinking when you hear that is this is whatever's left. If I liquidate everything in the company, turn it all into cash, so all my assets are now cash. I use that cash to pay off all my liabilities, so everybody that I owe money to, I pay off. And obviously, if I've liquidated everything, I've paid off all my creditors, whatever's left is what I get to keep as the owner. So again, that is my owner's capital or my owner's equity. And that is why the basic accounting equation should work. So we've got $83,130 for owner's capital. The rest of the balance sheet accounts we will just plug in from up here. So we got cash, 8,990. Oops. Yeah, 8,990. There we go. Then we had accounts receivable, 14,740. Then we had office supplies, 3,930. Then we had land, 45,980. Office equipment, 18,660. Accounts payable, oh, sorry, that's the end of my assets. So now accounts payable would start and is actually the only account in my liabilities account, so that's 9,170. So, 9,170. And my balance sheet balances, so that's always a step in the right direction to assuming that you have the right numbers down there. Now, if I was doing, if I was you all doing this, as I was going through these, I would probably check off or somehow notate that I've used up all of these accounts and all of this information and posted it in the relevant spot. But again, if you can do it from memory, not a huge deal as well. All right, so this next problem, let's see here. It's going to be similar again to what we looked at already as far as figuring out, determining the missing components, whether that be assets, liabilities, equity, etc., based on the basic accounting equation and our knowledge of the financial statements. So for this first problem, we're looking at company A. This is that column for this first problem. That's this first column right here. So we're given assets. This is as of December 31st, 2014. That's right here. 37,000. Given liabilities. 30,340. And again, similarly, we're going to subtract liabilities from assets, and that is going to give us our equity for that year. Then we've got what is the amount of equity on December 31st, 2015 for company A. So beginning equity for company A listed right here. To that, we want to add net income or net loss, any owner investments, and subtract owner withdrawals. So let's add owner investments, add net income, subtract withdrawals. So investments for that year during 2015 was 6,000, income 8,840, and withdrawals 3,500. That would give us our ending capital is this amount plus this amount plus this amount minus this amount equals 18,000. Next question, what is the amount of liabilities on December 31st, 2015 for company A? Okay, so since we have assets at the end of the year and liabilities at the end of the year, we can calculate that as well. So, I'm sorry, equity. We have assets and equity. So that was 40,000 in assets. Equity, 18,000. And the difference between those, 22,000. All right, moving on to company B. What is the amount of equity on December 31st, 2014? Company B, assets 28,860. Liabilities 20,202. Equity, assets minus liabilities. So what's the amount of equity at the end of the year for company B? Let's see, what are we given here? Oh, we are given company B, we're given assets and liabilities there as well. So again, 28,800 this time. Liabilities 19,584. That leaves my equity at assets minus liabilities. Now, calculate the amount of assets for company C on December 31st, 2015. Okay, so how do we do that? It's the last one of this type. What are we given for company C? Okay, so we're given assets and liabilities looks like we're going to have to work backwards on this. So we're after assets here. The way that we're going to have to do that is we're given assets and liabilities here. We'll find the equity here. And that will give us our beginning equity. Let's see. Yeah, that will give us our beginning equity for the year. To that, we will add and subtract the relevant amounts. That'll give us our ending equity for the year, which gives us 2 out of the 3 things we need to figure out here. And we can use that to figure out the last one. All right, so first step, find out equity here. So we got assets, $23,680. We got liabilities of $12,787. To find equity again, we're just going to take assets minus liabilities. So we've got this number minus this number. Whoops, I did that twice. Minus this number. And that gives us our equity for the year. So that becomes our beginning capital for the following year. And we're also given, so that's the kind of part C here that we don't see on this chart, but we need to answer our question here. Okay. Oh, I'm sorry, that gives us our part C here, and then we're going to use that with this information here to get part C for this, and then we'll use that to answer this. Sorry, I'm probably confusing y'all even more right now. Okay, so we started with beginning capital, which we just figured out here. We're given owner investments of $9,750, so I will add that. Given net income, or in this case net loss of minus 1,100, so I'll put that down here. And then owner withdrew $5,875, so that will also be a subtraction. We'll go ahead and let Excel do the math for us, so we'll do these as negative numbers. So that leaves our ending capital of this number plus this number minus these two numbers. Okay, that's $13,668 for ending capital, which goes right here. We're also given liabilities right there, $13,132. And now we just need to figure out this, and we already have it in the right format. Just add those two together. That plus that. And there we go for that one. Okay, so that's, I believe, all of the algebra we're going to do for this particular class. And then we're just going to do some of these journal entries. So for each journal entry, we'll put a date. 1st of August. And accounts affected here. We've got cash. It's going to be a debit to cash because in the eyes of the company, the company is receiving some cash and also some equipment. Okay, so we put those amounts in here. Uh, 31,175. And Harris Capital would be the balancing entry. So that would just be the total of those two. Oops. Sorry, I messed that up. Equals that plus that. And if you're wondering, okay, where did he come up with the name for that? Yes, I just know that that is what you would call that. But in this class, and even as a basic, entry-level accountant, you're never pulling account names out of a hat. It's always going to be like a drop-down box or select from these various accounts. So from that, you could probably very easily, even with no training, select the correct equipment account if you were given options, and cash if you knew that, hey, I need to record both of those happening. And then Harris Capital, that one might be a little more tricky as a beginning accounting student to know. But capital or equity, those two words are used interchangeably in accounting. So it may be called Harris equity or equity for Harris, or any combination of those things. But the good news is there wouldn't be more than one. So it wouldn't be like you were choosing between Harris Capital and Harris Equity, etc., etc. There was only going to be one of those variations, and you just have to know that you picked the one that it is. So anytime I'm actually grading you on any of these, I would definitely give you account names as choices there. Okay, so the cash and equipment are both assets, so the asset side of the basic accounting equation is going up by this amount, and the capital account is an equity account, and that is going up by that amount as well. We've got equal number of debits and credits, so all of my rules are satisfied there. Next event that happened, we paid $2,700 cash for an insurance policy covering the next 24 months. So this is going to again involve some cash, and actually, sorry, I should put prepaid insurance is going to be the name of my asset account where this insurance is getting stored, and cash is going to be the account that's credited here. Incidentally, how did I know that I was going to credit Harris Capital and debit these two accounts? Well, there's the easiest way to think about that is in terms of the basic accounting equation and your knowledge that everything that's on the left side of the basic accounting equation carries a debit balance, meaning to raise it or to increase the account, you would debit it, and everything on the right side of the basic accounting equation carries a credit balance. So to raise or cause that account to go up, you would add credits to it. So what does that mean, or how is that relevant to this scenario? Well, if you know that cash and equipment are involved, and you can think logically, okay, I'm adding cash and equipment to the company, so those accounts should go up. That's a debit because those are on the left side of the basic accounting equation, and I want them to go up. On the right side, we've got this Harris Capital account, and in this case, that is what is balancing this increase to the assets is an offsetting increase to owner's equity. So I know these accounts are on the right side of the basic accounting equation and carry a credit balance. I want to increase this account, so I'm crediting it. That's one way of thinking about it. I think the easiest way of thinking about it. Okay, so down here for this account, I'm increasing the amount of prepaid insurance I have, and I'm decreasing the amount of cash that I have in my company. So it's a debit to prepaid insurance, a credit to cash. Again, similar with account title or names, you would be given those. And I should have put a little description here. Initial owner investments or something like that. It doesn't have to be wordy, just a brief description of what's happening here. Prepaid, 24 months of insurance. Okay, 5th of August. Office supplies are increasing. Cash is decreasing. So I have a debit to office supplies for that amount. Credit to cash for that amount. Purchased supplies. 20th of August. Received $3,400 cash in photography fees earned. Okay, so obviously we're getting some cash here. And that's increasing our cash. So that's going to be a debit to cash. And on the credit side, this is going to be a revenue account and likely would be called fees earned. And again, with revenue, revenue actually does follow the correct rule, but I mentioned that with revenue and expense, probably better just to memorize that revenue carries a credit balance, expense carries a debit balance. So when I increase revenue, I will credit it like I'm doing in this case. So that causes everything to stay balanced the way that I want it to. Earn fees for services. And then finally, my last journal entry of the month here. We've got cash being paid for August utilities. So we've got an expense occurring here. Utilities expense, that's a debit. Like I said, expense accounts carry a debit balance. If you want to increase them, you will debit them. I want to increase my expense account showing that an expense was incurred and paid. And then we paid with cash, so that will decrease my cash account. And that's what that journal would look like at the end of the day. All right, last set of questions here. Again, we've just got some journal entries to do. I guess in these cases there's no date, so we'll just put the transaction number here or letter. The owner invested $19,500 in the company in cash, so the cash account of the company goes up by that amount. Spade capital would also go up by that amount. Well, it doesn't say initial investment, so I'll just put owner investments. All right. B, company purchased office supplies for cash. Office supplies are increasing by this amount because this is, again, going to just kind of hold the value of those items until we use them up, at which time they will turn into expenses. But for the time being, this is just trading one asset for another. So cash goes down, office supplies go up. Okay, next we've got C, office equipment purchased on credit. Credit tells us this is going to be an accounts payable, unless usually it would specifically say if it's going to be a notes payable. All right, that was for $10,784. Purchased equipment on credits. All right, D, whoops, received fees for, or received cash for fees. So we got cash coming in, fees earned. That was 2,301. Earned fees from services. All right. E. Oops, I guess it did give me account titles here. I guess I should have looked at those before. I pretty much came fairly close. If I didn't get the words exactly right, you all are competent enough to understand what I meant, I hope. But yes, I guess I should have turned on my attention to detail for this question and actually used the correct names here. Okay, so anyway, what was I saying here? Earn fees from services. Okay, next one, letter E. Company paid cash to settle the payable. Basically, we're paying off this payable that we had here. So what do I want to happen here? I want my account payable to go down. So I'm going to debit that. And that is essentially wiping it off of my books. In accounting, you don't ever erase something from the books. If you want to get rid of a debt or something and you've paid it off, you would just show an offsetting amount going on the other side of the balance here. So instead of being a credit, it now goes on the debit side, and that reduces the account to 0. Then here on the credit side, that would be cash going down, because obviously that is what I used to pay off the receivable, or the payable. All right, F, company billed a customer $4,134 as fees for services provided. So this is basically saying, hey, we've billed it, we've earned it, but we've not received it yet. As soon as I send that bill out, then I'm going to mark this down as having been earned, essentially. So even though I haven't got cash, I do now have a need to be paid. So I've got accounts receivable for that amount here, $4,134. And I will consider those earned because I've done the work. Add some space here. Whoops, that's not where I wanted to add it. All right. Billed for fees earned. All right, and we got G, paid $530 cash for monthly rent. Whoops. Rent expense is going to be the account. It's an expense. Got how much already? 530. Paid in cash, so cash will go down. Subscription, paid rent. Still didn't give myself enough space here. Okay. That will leave us at H. Company collected $1,736 cash as partial payment for account receivable from transaction F. We don't really care that it's a partial payment at this point. We will treat it the same way. Actually, clean this up a minute here. All right, like I said, I left off, sorry, a little OCD here. I didn't put, there we go. Okay, now that I've corrected that, someone is paying part of the receivable that we put down here. They're paying off $1,736 of it. So cash is going up by that amount. Accounts receivable are going down by that amount. And since it's an asset account, it's on the left side of the basic accounting equation. If I want to show it going down, I credit it. Just the opposite of what I do to show it going up. So I want that to go down. And why do I want it to go down? Because I'm essentially erasing that amount of account receivable from my books, or the effect of that by putting an offsetting balance on the other side of the balance. And what that does is it allows me to look at my balance on accounts receivable and see whatever's left in that account is what that customer still owes me once I put that offsetting balance in there. Okay, I think the last transaction here, yeah, owner withdrawal of $800 for personal use. So we've got spade withdrawals, or just owner's withdrawals. I should have looked up here. Yeah, they actually list spade withdrawals. So that's my account there. And from the company's perspective, cash is going down. So we have $800 less in the company accounts than we did before. This confuses people sometimes because the owner himself or herself is being enriched by $800 of cash. But again, from the company perspective, cash is going down here. Sorry, just looking down at the next question. I didn't realize I had more to go here still. All right, so I'll just put my description here. Owner withdrawal, not that that one needs a big description. All right, and that finishes off those transactions. Now moving on to these transactions down here. April 1st, company retained an attorney for a flat monthly fee of $2,000. Payment for April legal services was made by the company on May 12th. Okay, so we've got these three separate situations. Require adjusting journal entries to prepare financial statements as of April 30th. For each situation, present both the April 30th adjusting entry and the subsequent entry during May to record the payment of the accrued expenses. Okay, so for April 1st, guess we're just worried about the adjusting entry. Okay, so we have not paid April's fees here until the month of May. So at the end of April, we need to record the fact that we owe somebody some money. If I was going to have that as an expense account, I would probably say legal expense. Since I've incurred this expense already as of the end of the month, that's, again, when I'm talking about recognizing the expense or the revenue and when to recognize that. The expense I want to recognize whenever it's been incurred so I can match that with the revenue it helps to earn. So this has been incurred as soon as I owe it, essentially, as time passes. So as of the end of the month, I owed the entire amount. I just didn't pay it yet. So I will recognize the full amount of that expense. Then down here, I would just call that part of my accounts payable. So that as of the last day of April, and I think there's 30 days in April. As of the last day of April, that is on the books. And then come May, we go to pay that off, and I would debit accounts payable, showing that no longer has a balance. Those two would offset each other, leaving a zero balance, and cash would be paid at that date. So this credit to cash would show cash going down. All right, next one. The next one is some interest that has accrued over the period between when we last paid interest at the 20th of April and the end of the month. We won't pay interest again until the next month. So we do, as of the end of the month, want to show any interest that has accrued over that time. This again would be an example of an accrued expense that we haven't paid yet. So we still are going to recognize that as an interest expense. So anytime you see the word expense in an account title on a journal entry, that is what is happening. We're recognizing the expense. Or in other words, because we put down this journal entry that has expense in the title, it will show up on the income statement. That's what recognizing the expense means, or recognizing the revenue. Will it show up on the financial statement, the income statement for this time period? So as soon as we do a journal entry with that title in it, it will show up during that time period. Excuse me. So the amount that accrued here, $13.69, and we probably have an interest payable account specifically allocated to that, or it might show up in accounts payable. Usually that would show up in an interest payable account, but theoretically accounts payable kind of serves as a catch-all a little bit as well. Okay, so accrual of expense, and then come the 20th of May, we will pay off this interest payable. $13.69, and then we would actually, the total amount we're going to pay would be the full interest payment on this date. So that's going to be the cash that we pay. And the difference between those two is made up in interest expense. So again, remember that we only this amount showed up on the income statement last period at the end of April. And the rest of that, the difference between that number and this number, needs to show up on the income statement at some time. So it will show up during May, because that's the time, during the time that those 20 days elapsed, during which this interest built up, essentially. So that's just going to be the difference between this number and this number to make up the difference there. Finally, we've got some salaries that are going to accrue. Total weekly salaries, $11,000. Amount is paid at the end of the day on Friday of each 5-day work week. So you work 5 days and get paid on that Friday. But this month, April 30th, falls on Tuesday of this year. That means there's 2 days that have been worked since 2 days have been worked before the end of the month that you haven't been paid for. So at the end of the month, we want to show salaries expense that we haven't paid yet. So these are going to be salaries payable for the amount of hours essentially that have been worked. That's 2 of the 5 days. So if we just divide this into 5 days, that's going to give us 2,200 per day. And 2 of those days would be 4,400. And then it's just a salary accrual. Accrual, again, just means kind of building it up, even though it hasn't happened yet. And then here, May 3rd, we go to actually pay the payroll, which again we said was $11,000. So part of that is going to be made up by salaries payable being erased, or as much erased as we can in accounting. And the other part is going to be the rest of our salaries expense or wage expense to make up the difference to get us to the full cash payment that we're paying for those wages. Okay, so that's how we got through all of those. I guess I didn't put this final description on here. Payment of wages. All right, if you have any questions on these, again, I will post this document with the answers on it, and you can email me or just let me know if you have any questions.